The 2008 financial crisis, a comprehensive summary. The 2008 financial crisis, also known as the Global Financial Crisis (GFC), was one of the most severe economic downturns since the Great Depression of the 1930s. It was triggered by the collapse of the housing bubble in the United States and had profound global implications, leading to the downfall of major financial institutions, a sharp contraction in global economic activity, and significant government intervention to stabilize the financial system. Below is a detailed overview of the causes, key events, and the aftermath of the crisis. 1. Causes of the financial crisis. The roots of the 2008 financial crisis can be traced to several interrelated factors, including the U.S. housing market bubble, financial deregulation, excessive risk-taking by banks, and flawed financial products like mortgage-backed securities (MBS) and collateralized debt obligations (CDOs). A. Housing market bubble. During the early 2000s, housing prices in the U.S. began to rise rapidly due to low interest rates, easy access to credit, and a strong demand for homeownership. This led to a speculative housing bubble, where homes were being purchased and resold for profit rather than being bought for living purposes. Lenders relaxed their standards, issuing subprime mortgages to borrowers with poor credit histories, fueling the housing boom. B. Subprime mortgages. Subprime mortgages were loans given to individuals with low creditworthiness, and they were often issued with low initial teaser rates that later adjusted to much higher rates. Many borrowers could not afford these higher payments, leading to widespread mortgage defaults when rates reset. C. Financial innovation and securitization. The practice of securitization allowed banks to bundle mortgages into securities (MBS) that were sold to investors. These securities, often including high-risk subprime mortgages, were rated favorably by credit rating agencies, despite their underlying risk. Investors, including global financial institutions, purchased these securities without fully understanding their risk exposure. D. Excessive leverage and risk-taking. Banks and financial institutions increased their leverage, the use of borrowed money to maximize profits. This meant that even a small decline in asset values could have catastrophic effects. At the same time, financial institutions engaged in complex and risky derivatives, such as CDOs, which amplified the impact of mortgage defaults. E. Deregulation of financial markets. In the years leading up to the crisis, financial deregulation policies allowed banks and other institutions to take on excessive risks without adequate oversight. The repeal of the Glass-Steagall Act in 1999, which had separated commercial and investment banking, is often cited as one of the key enablers of the crisis.